Hi, we're Team B.
I'm Noah Basable. I'm a junior marketing major from Tokyo, Japan.
I'm Scotty Dye. I'm a junior accounting and finance major from Carrollton, Texas.
I'm Brody Benj, and I'm a senior agribusiness major from Lubbock, Texas.
So we, Company B, are in the muesli cereal market. We operate in Germany, and we operate in 3 regions. We operate in the north, west, and south regions of Germany. Obviously, there's a lot of competition, and so we operate under low profit margins, but we expected high sales volumes. And so we have 6 product types. We have strawberry, original, nut, blueberry, mixed, and raisin. And our mission statement is to deliver high quality, delicious muesli at an affordable price to the everyday customer.
As you can see, we have 3 people in Company B. First, we have Noah Basable. He was in charge of our marketing and sales and pricing aspect of it. You see it was marketing expense, change production design, increase capacity, as well as pricing and sales analysis. Scotty Dye and myself both kind of worked on this forecasting of sales, and Scotty also worked on calculating requirements, loan repayment, doing all of our financial analysis, and conversion of raw materials. I was more in charge of the operations side of things and making production, purchasing materials, calculating our requirements, also reducing our setup time, and all in all, just make sure that our production schedule was on time and that it was released.
So now we're going to talk about our required operations. So we had 5 major transactions that we had to do for the simulation. So the first is a change in the bill of materials. So this involved us changing the composition of our product. So for us, what we decided to do is we increased the amount of wheat and decreased the amount of oats that was in our nut muesli. So our next transaction was the initial forecast. So this allowed us to predict about how much we were going to sell of each product. And so after we set that guesstimate, then it would allow us to order up to about that much in raw materials. So then we had our investment to reduce setup time, and this was critical to us turning over our raw materials into finished product. And so we invested about, I believe it was $160,000 in our to reduce our setup time by about 4 hours. So we went from 12 to 8. Then there was the investment to increase capacity. And so we tried to do this 2 times at first and it didn't go through. And so then the 3rd time we changed it and it increased our warehouse capacity so that we weren't getting as many warehouse fees, although we did still have many. So then our last transaction was the loan repayment. Unfortunately, because we were at a net loss, we were not able to pay back very much of our loan. We only paid back, I believe, about $30,000 of it because we needed to get the transaction done. So all that to say, if we would have had a chance to do it again and had a positive gain, we would have slowly paid back our loan over time. Okay, so now let's talk about our financial statements. So if we look at our income statement, we can see that our total cost of goods sold exceeded our revenues. That's very bad for business and goes against every rule in business, essentially. Some things that we could have done to change that, our revenues, we could have upped our pricing to where it would have generated more profit per unit, and that would have increased our revenues. And also our cost of goods sold, we couldn't have really changed that much, but our revenues would have covered our costs if we would have priced it appropriately. Next is equity. This was on our balance sheet. And this is a number that a lot of investors will look at when they are looking to invest in our company. As you can see, our equity is negative $377,151. So when an investor sees that, they are not likely to want to invest in our company. So that's something that we would have liked to improve. And so finally, we're going to talk about our marketing expenses. Overall, they were pretty average, pretty competitive with the other companies. However, our strawberry muesli was much higher in marketing expenses than the rest of them. If we look at the West region, we can see that the strawberry muesli in the West was $2,000 $22,500 in marketing expenses, as compared to another product in the West, the nut usually was only $3,800. So this is a drastic difference between the amount of marketing that we put towards these two products, and that was something that we would have liked to have changed.
After round 4 of the simulation, we decided that we needed to analyze all the things that we had done and really come up with what we thought we did well on and what we did poorly on. As you can see here, we've decided to use total sales, round productivity, and gross margin. Our total sales are in the top 4. This may seem a little odd because we're actually in the top 2, or in the bottom 2 of the rankings at the end of the phase. You can also see that our gross margin is at 68.9% negative, and our round productivity is 91.6. This being said, I believe that our total sales were so high because our gross margin was so low. We were selling things for a discount rather than making money out of them. We were actually losing money, so any consumer would be more than happy to buy them for less than what it costs us to make them. So I believe that's where our total sales came from. Our round productivity also came from the fact that we had so much inventory on hand, which was one of our biggest faults. We had too much inventory, and we had to pay extra to have it stored. But the productivity is so high, I believe, because while we did have all that inventory on hand, we didn't, there was no lag waiting on raw materials. Our facilities were always in production. We weren't ever waiting for materials. So that's why our productivity is so high, but that's what ultimately leads to our gross margins being so low, is the fact that we don't have, we had so much expense from the warehouse and storage and everything else that we didn't match that with the price of our product.
Although overall we did not do well in this hypothetical situation, if we were to expand our business to another country, we figured we'd want to go to a neighboring country. And so that narrowed our initial candidates to Poland, the Czech Republic, Austria, Switzerland, Belgium, Netherlands, and Denmark. We then narrowed it down based on GDP measures, such as nominal GDP or their annual growth rate. And then we came down to Switzerland and Belgium. Belgium was good because they have a high net disposable income, according to research we did done by Deloitte in 2014. And it was after Germany and France, which are two very big countries, but they weren't next to Germany. And however, one of the setbacks for setting up in Germany would be that they have a very high tax rate. They charge 25% on cash deposits, interest, and dividends. And so that kind of demotivated us to go to Belgium. And so we then looked at Switzerland. And as we all know, Switzerland is famous for their banks, watches, and chocolate. They also have a really good steady economy, and it's not as big as Germany, but it's not doing bad as Greece. And so going back to the research we did done by Deloitte, Switzerland had the second highest average wage in the European Union, and they also had the 13th highest GDP annual growth rate. And we thought, Germany is the biggest economy in the European Union, and Switzerland was the biggest out of the neighboring countries. And either way, we were going to have to downsize, and so we figured Switzerland would be a good fit for us.